If you've been struggling to find valid market structure or change of character, or you've been losing or missing trades because of it, make sure to watch the video till the end. In this video, I'll go over when to look for market structure shift, 3 types of market structure shift you may not know with examples, as well as both invalid and high probability market structure shift conditions. If you need one-on-one mentoring sessions, check out the description. This is Mulham and let's get into it. Now, first of all, we gotta start with this question. When do we look for change of character or market structure shift? A lot of people, especially people who are using indicators, they're literally looking for market structure shift anytime when there is, let's say, a higher high is taken or a lower low is taken. Every time when we are in a downtrend, for example, and then there is a high taken, any high, they consider this as a change of character, especially people who are using indicators, because indicators don't know all of those stuff. They're not as smart as you or as smart as me. So that's the problem with indicators. So that's why we only look for change of character or market structure shift after there is a liquidity sweep on the higher time frame or price trades into a higher time frame period array. Those are the only two cases when we look for a change of character. Otherwise, we're not really interested. Price can take the higher high, can take the lower low, and still there is no change of character, there is nothing. Only those two scenarios. When there is a liquidity sweep, same as in this case, liquidity sweep, then price going lower, now we're gonna look for the swing to be taken as a market structure shift. However, if this is not a high time frame liquidity sweep and it's basically, just a short-term high, then we're not really interested. Same thing here. If this is a point of interest, especially on the higher time frame, that's when we look for a change of character or market structure shift. That's the only case. Now, I'm gonna go over 3 types of market structure shift and change of character. A lot of people may not know because they only know one tab of those, which is usually the most common one. However, there are some times where you'll be missing trades if you don't look for the other types. And a lot of people, even in my Discord, they miss the trades because they're only using one type and not using the others. While others can, be much earlier, and it gives you an indication that okay, there is a market shift. So I'm gonna go over those types with examples. If you're looking to secure up to $4 million in trading capital, look no further. Bespoke is one of the best firms in the industry now. Trade at your own pace with no time limit, very low spreads and slippage. Request a payout in 14 days and get it in less than 24 hours. Balance-based daily drawdown and much more other features. For a special 10% discount on all accounts, use code MULHAM at checkout and find all links in the description. Let's continue. Now first, starting with the tab 1, and it's the most basic one, however, it's very useful and it happens a lot. It is basically when there is a liquidity sweep and we look for either the last valid pullback or the last intermediate term high or intermediate term low. And it happened in 2 forms. Okay, let's start with the pullback first, and this is a lower probability. Why? Because it's more risky. So what is a pullback first? Pullback, let's imagine that price is going down, and then we have this candle right here, and then we have price taking the low of this candle, and then price going up and taking the high of the candle, and then this is a valid pullback. And I do have a video about valid pullbacks, so you can watch that one, but it's basically taking the low then taking the high. That's a valid pullback. We don't want to see inside candles as valid pullbacks. This is the first one. So if I see before the sweep, so the sweep happened here, before the sweep, if I see a valid pullback here, I can consider that as my change of character. If it's right here, then that's my change of character. I want to see a candle closure below this line here or below this swing. Now, a higher probability condition is if that low or if that high, in this case, we're talking about a low, it should be an intermediate term low. And if it's a high, it should be an intermediate term high. What does that mean? It means that when price was going up, and the same scenario here, price going up, going lower, and then going up. At this point, I want to see price reacting from a fair value gap. As you see here to the right, there is a fair value gap. Price come back to it, react from this fair value gap, goes up, then we have the sweep, then price coming lower. Now closing below this point, that's a high probability change of character or market structure shift. Why? Because this is now an intermediate term low in this case. Okay, So that's a much higher probability. Now it's always better to have this as a higher time frame liquidity sweep, not just the same time frame. It gotta be a higher time frame sweep to be a higher probability change of character. Now let's go and cover an example here. So what do you see? 30 minutes, okay? On the 1 hour, you could see that there is this liquidity level, and it's actually a higher time frame also. Because if you go to the higher time frame, this is a very major liquidity level. It's taken right here and price goes up. What do we see in this case? So this example right here is the intermediate term high example. This is a higher probability. So basically, we have liquidity sweep here, price stay one candle, two candle below the liquidity level, and then price come back into the range. That's what I always want to see after a liquidity sweep. I want to see price doesn't hang around here below and then immediately comes back into the range. That's what's happened here. Now, when the sweep happened, what is my last valid pullback? Now, this is a valid pullback, but also an intermediate term high. So we have a fair value gap here. Price react from this fair value gap, then go lower, and after that, price closed above this intermediate term high. That indicates a change of character or market structure shift, and it's a high probability one. Now, price keep going up, and it also goes above this point, so that's also another confirmation that there is a change of character. Now, you can, after this candle here, you can already have your, for example, limit order here or at this fair value gap also. But if when price goes up and continue going up, you would know that, okay, now this is a high probability change of character also because another high is broken too and violated, okay? And then price goes lower, as you can see, and at the end comes at this zone right here, okay, to buy, and then you can buy here. So in this scenario, this is also a valid pullback, but also an intermediate term high, which makes this a high probability change of character or market structure shift. Now, the type 2, and a lot of time I see this happening, and a lot of people miss trades because of this. What is this? So it's basically an intermediate term high or intermediate term low, but we don't have a liquidity sweep here on the lower time frame. So basically, we have one higher time frame liquidity sweep right here, and then price goes lower, then it goes up, but there was a fair value gap here. Price react from here, which makes this an intermediate term low. Price goes up, it creates a failure swing. So basically, price doesn't go above this point. It just reacts immediately and it creates a failure swing. Price goes lower. When price closes below this intermediate term low in this case, that indicates a change of character or market structure shift. A lot of times people will be waiting for another sweep up here. It's not going to happen and price will go lower. They don't see this intermediate term low. They don't see this fair value gap, and they're still waiting for a trade all the way up here. When in reality, it's not going to happen. Why? Because we had an intermediate term low here. Price closes below it. That indicates change of character or market structure shift. So please focus on this as it's game changing. A lot of people miss trade because of this, but if you really practice it, you're going to see it. And I know a lot of people building a setup or a model just based on this, literally based on this. Going over an example here. So what do we have? This is the 3 minutes. If you go to the, let's say, to the 15 minutes or even the 5 minutes, you would see this liquidity level right here. You see almost two failure swings. Price takes that liquidity sweep and then 1, 2, 3, 4, 5 candles below the liquidity level, and then price comes back into the range. And those candles below the liquidity level are not, they don't have that much displacement. We don't need to worry about this. Price comes back and then react from here. What is this? This was a fair value gap. Price literally reacts from here and then goes lower. Now, a lot of people are expecting price to go as low as, maybe below this point and wait for another sweep. What happened is price goes up and break above this intermediate term high. Some people are still waiting for this low to be taken as a change of character if they're not familiar with this condition here. In this case, what happened? Price closed above. Now you can actually buy from this zone right here because this is the only fair value gap that you have. Price comes here and then goes up. everyone who was waiting for another, sweep below here, or basically, the type 1 change of character, they're not gonna find it here and they'll miss the trade. As you can see, price create a failure swing here. So a swing and then, or basically a low and then a higher low. It did not create a lower low, right? That's the only difference here. And then this also another difference is the intermediate term high. Price react from here, goes lower, breaking above this point now is a change of character. Now this is the last type, and it's, I would say it's the earliest one ever. So this is the earliest indication for a change of character or market section shift, and I do have a full strategy just relying on this. Full strategy, you gotta watch the video, full strategy, based only on the inverse fair value gap. So what are we waiting for here? We don't really care about the swing. So if this is a intermediate term low, if it's a pullback, we don't really care. What we are really looking for is a sweep on the higher time frame. We go down to a time frame that has only one fair value gap on this leg right here. This is the manipulation leg. I only want to see one fair value gap. Price goes lower back into the range. If a candle, and in this case, this candle, if a candle closes below the fair value gap, the single fair value gap, that indicates a change of character. You can immediately enter after this change of character, and you can also wait for a pullback into the inverse fair value gap. Okay, so a fair value gap is supposed to hold price up in this case, but because of this sweep, we're expecting this fair value gap to be disrespected. That indicates there is a change of character. In this case, you can immediately enter with the retracement, and make sure to watch my full video about inverse fair value gap. Now going over this example right here, what do we see? Liquidity level taken right here, 1, 2, 3. Only 3 candle stays below the liquidity level, and this is the 15 minutes. Those candles also don't have any displacement. Maybe this one, we can be subjective here, but this one, no displacement. This one, just displacement to the upside. And then price comes back into the range. In this manipulation leg, from here to here, we only have one fair value gap, which is this one, from this point to this point. This is the fair value gap. This candle doesn't close above it. This candle closes above it. Now, if you're looking at type 1 and type 2, where would be your, and in this case, it's actually type 1, okay? Where is your change of character gonna be? Right here at this point. Why? Because this is the last pullback, and it's also an intermediate term high because it was reacting from this fair value gap right here. But in this case, you would be missing the trade if you waited for this change of character right here. When you have this single fair value gap and it's, you see price closed above it, then you can immediately wait for retracement to the downside. And what happened here is a candle closure above this level right here, which is the end or the high of the fair value gap. Price closed above it. Immediately, this is a change of character. Price comes back into the inverse fair value gap, and also we have a fair value gap here. If you don't really want to enter from the inverse fair value gap, a fair value gap from this point to this point, price comes here, then go up. If you're really waiting for this change of character, most likely you miss the trade unless you enter here at this fair value gap at this level. But I think this was out of the kill zone, so you most likely missed the trade just because you're waiting for this high to be taken when you have this early indication, which is the inverse fair value gap. Now going over the invalid change of character, there's some scenarios and some conditions where we're gonna say, okay, there is no valid change of character in here. And I really want you to understand this and use your brain here, okay? Use your mind. Say, okay, I'm not really entering here. Why? Because I feel like, oh, there is something here, there's something here, and I'm gonna go over this. So let's say that price was going down here. We had a point of interest, and then price mitigates that point of interest. Goes lower. We had a breakout structure. Then price comes back again into another point of interest. So we can see a clear order flow here going down. Price comes with a displacement to the downside, and it reaches a point where it gives a small reaction and then a sweep of this low right here, which is a short-term low, and then going up above this point. The thing is that there is no higher time frame point of interest at this point, and there is no higher time frame liquidity sweep. So basically, price just randomly react from here because it was going down aggressively. It's just a random reaction from here. Now, at this point, price goes up and we have fair value gap here maybe, and maybe another fair value gap here, and we have a point of interest. Now, if price goes up and break above this high, that's not really a convincing change of character. And why? Because price did not go into a higher time frame point of interest and would have a higher time frame liquidity sweep. So basically, price going up is only a mitigation of the point of interest to go lower. What is another reason too? Those fair value gaps. I don't want to see a lot of fair value gaps on this leg when price is going down and then we have a change of character. The thing is that it can be the same. Price can come here into one of those fair value gaps after taking this high and then mitigate one of those fair value gap and go lower. So literally the same scenario as the point of interest mitigation or the order block. In this case, this is an order block and those are fair value gaps. I'm just making two scenarios here. So not really interested in this. What makes it invalid the most? It's just the higher time frame liquidity sweep and no higher time frame point of interest. That's what makes it invalid. Another condition is that when price was going up here, it was going aggressively to the point of interest, and then we see a reaction or a very big displacement to the downside. In this case, you gotta be careful here. You don't want to enter. Why? Because you can see price literally went up only to mitigate this point of interest and then keeps going lower. As well as in this leg, as price going up, there was no liquidity building up, no inducement. And if you're not familiar with this, watch my last video about inducement. It's gonna blow your mind about the use of inducement. In this case, we don't have no inducement here, literally no inducement. So when price coming down, price needs to take some liquidity before going up, right? But in this case, there is no liquidity here. What is the nearest liquidity to price when going lower? It's this low now. This is the level of liquidity. And that's why this level would be taken, just because there is no liquidity here on the way. If there is 1, 2, and 3 liquidity levels here, price will get down, take those levels, and then will react because it already took liquidity and now it can go up. But in this case, when there is no liquidity at all, this would be the liquidity and this low will be taken. Always think using this logic. If price going up, are there liquidity levels on the upside that price can take before reaching my point of interest? If there are, then your point of interest is a high probability. If there is none, then most likely your point of interest is the liquidity and you would be the liquidity. We always don't want to be the liquidity, right? So always think this way. Now, as we discuss the invalid change of character, let's go and cover some high probability condition of the change of character or the market structure shift. So the same thing. So first of all, price going lower here, and then price reaching a higher time frame level, or a higher time frame PD array, or a sweep 2. Price goes lower, then goes up and goes lower. So we have another sweep here. That's what I always want to see. Not always, but that's the high probability one. So we want to see a higher time frame sweep or higher time frame point of interest, and then first reaction. I want to see that first reaction to be taken. So price goes up, a small retracement or pullback, and then price taking that first low that was reacted from the point of interest or the liquidity sweep. So a higher time frame sweep and then another sweep on the same time frame. On this case, what I want to see to the left, I don't want to see a lot of fair value gaps here. Why? Because every fair value gap has a 50-50% to react from. So when I have no fair value gaps, that means, okay, price can go up now. It has more freedom to go up. And like if there are multiple fair value gaps here, price is going to be struggling to go up. So I don't want to see a lot of fair value gaps here. And then I want to see this to be an intermediate term high, which is basically means that there was a fair value gap, a small fair value gap that price goes into and then react. Price goes up with the displacement. I want to see displacement and leaving a fair value gap most likely. With displacement, there is a fair value gap, and this displacement should be happening also above the intermediate term high, above that swing. When I see displacement above that point, then that tells me most likely this is a high probability change of character. Another thing is that I want to see an inducement created here. So let's see this. So let's take a look at this. Price comes here and then goes up. A lot of people thinking, okay, we're gonna buy here and our stop loss is gonna be here. But actually we have an unmitigated point of interest or fair value gap. So this is a liquidity level now. What happens is that price comes down, and we all know that when we have fair value gap and a liquidity above it, that's a high probability liquidity sweep. What happens is that price comes, and we know after a liquidity sweep, price want to go up, right? When price sweeps a low. And how about if there is a point of interest below that level? That's another support for price to go up. So we have two things here that's gonna make the price goes up. So that's the high probability condition here. We want to have an inducement here, point of interest below it, and price can go up later. Now, two more things that we can look at is we need to have a clear drawn liquidity. So if we have a change of character here, and our higher time frame drawn liquidity tells us that okay, there is a fair value gap right here. Right here, there is a fair value gap. Like let's say at the word here, the change of character, there is our drawn liquidity on the higher time frame. If this is the case, then that's gonna be a high probability change of character. Why? Because we're literally having a change of character toward the drawn liquidity. Another thing is that I don't want to see a major liquidity level to be taken before price comes to the point of interest. So in another case, so let's say price come here and then we have the inducement happening, and then price just goes up all the way to the drawn liquidity and a liquidity level taken. Would you still be interested in buying here? No. Why? Because price already took the major liquidity level. Now you can, and sometimes it's gonna work as everything else, but it's gonna be a low probability. I want to see the liquidity level not taken until price comes to my point of interest, then I want it to be taken. That's always the case. Now, this is the end of the video. I really hope that you guys learned something new. If you want to support me and if you want to motivate me to make new videos, then hit the like button, subscribe to the channel, and leave a comment. Also, join the Discord as we do a lot of stuff there, educational stuff and live trading and seminars, a lot of stuff. This is Mulham, and I'll see you in the next video.